All right, stocks end the week on a high note, about the exact opposite of what they possibly could have done. So we're going to break down this 4-day losing streak that we had today and see kind of how bearish it is. So how does this align now with what our expectations are going forward for the depth and breadth of this bearishness, and what could we see as next week? Are we going to follow through with this? Are we going to bounce back up? How long will we bounce back up? What's the likelihood of that happening? Where could we bounce back up to? All those things. What do we expect the bounce up to change the trend? All those things we're going to take a look at today, based off of what the indicators and what the charts are telling us. Then we're going to take a look at what's driving the price action, some significant moves in some different asset classes, and then our trade idea of the day is going to be in a stock that, unlike it's on its own little downward move, but has been a lot more tame. So we're going to take a look at maybe how do we trade something like that. It's got some relative strength in a really weak tape. So let's go ahead and get started. Today is Friday, January the 21st, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going looking at some of these charts, subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when the videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today. You want us to do another one again tomorrow or Monday. Comment down there also with anything that stood out to you from the video today. Let me know what questions or comments you have. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we got a cluster. So we had 4 days in a row to the downside after starting off the week, or finishing the week last week with an up day. Remember, no Monday. And then we started off 4 days all week, every day this week to the downside, getting progressively bigger too, as you can see. And then finishing the day. So at the start of the week, we ended last week with the intermediate line just barely dropping below the bullish territory. We finished the week with a cluster that quickly. So the short-term sentiment stayed extreme for 3 days in a row. Near-term line and the momentum line both in really extreme territory for 3 days in a row, finishing with the cluster. The market forecast here, the S&P finished nearly 6% below its moving average. That's obviously the biggest in the last year. If you look at the last 5 years, that is one of the biggest. Obviously, you have to take out the COVID. That's kind of an anomaly there. But if you go to 2018, that's about how far we got down there when we started to hit, and with a cluster too, when we started to hit a low point. About also as far down as we got here, we got down to 6.5% there in beginning of 2018. Of course, at the very end, when we kind of went parabolic there with multiple clusters, we got down 11% below. So needless to say, it's a pretty decent number. Obviously bigger than any intermediate decline. All these other smaller dips are all intermediate declines, as you can see up at the top. It's bigger than any intermediate decline. So you could argue that we are in a here. I'll put this on here and change this to minus 5.98. So this is where it's at right now. You could argue that, so you can see all these intermediate declines are all less than 6%, right? Usually about 5%. And then there's 18. There's the end of 18. There's all 2017. We never did get close. There's 15 and 16. There's the other market sentiment decline / death cross that we got. And you can see all these other levels here in 2012 and of course earlier in 2011. If I were to go 15 years, we can get back to 2011. Which would be in this area, like we were way below. But again, you can tell that how significant this level is for getting below the moving average. So, but this is not just going to be the normal intermediate decline like we've seen last September, October, like we saw this September, October before that, even some of these others, right? We are significantly down there, and it doesn't mean we're going to fall off a cliff here. It does mean that all the impulse moves, all the direction of the trend moves are to the trend is to the downside. So any rally is a pullback. Now, once the pullback doesn't start until you get above the 23% retracement, And it doesn't end until you either get back down below the 23% and we maintain the trend, or we get above the 78% and we start, a new trend to the upside. So that's the S&P 500. If I were to take a look at the weekly chart here with the market forecast, you can see after getting it, we just barely got an overbought cluster on the weekly chart a few weeks ago, going into the end of the year there. That was the holiday week in between with a really small range. Since then, you can see the momentum line. I mean, this week really has dropped. I mean, it's the first time we've been below the 30-week moving average this entire time. And you can see some of these other, once we dipped in 19, you can see in 18, and we got below there in October, and then, had a couple of good bullish weeks before we went below and actually got dark pink shading in a red line. That's what happens during market sentiment declines is that you will get the intermediate line on the weekly chart down into bearish territory like we did there, like we did in 2011, like we did in 2010, and of course with the bear market there. So now, again, you can see the intermediate line's just barely dropping below 80. Kind of like what we saw there with that first week in COVID. We were just barely dropping below 80 right there. Much bigger drop, of course. COVID was a much bigger deal. But that's kind of the environment we're in. The momentum line is at an extreme low. The near-term line is in oversold territory. So you can see that this is a lot. Even the last time that we had those kind of conditions, we weren't nearly as bearish. It was just a really small range there in September of last year. This is a much more significant deal. Let's take a look at the Russell 2000. Remember, that looks a little much different. We've gotten 3 clusters the last 3 days where we had short-term sentiment extremely bearish. All 3 of those days were clusters on the market sentiment. The markets, on the intermediate line, market forecast line. The market sentiment line is almost it's already in bearish territory. It's almost in the lower reversal zones. If you look at its weekly chart here, there we go. Just kind of zoom in on that. There's its weekly chart, and you can see its intermediate line is in the bearish territory already. So remember, the S&P has just barely started, right? The Russell started way back here. So it got that light pink shading yellow line way back here and just started. And now you can see the market sentiment line is just barely coming down. Short-term sentiment looking very bearish, and you can see the drop. In fact, the Russell broke. It's the only one so far that has broken the 23% retracement of the post-COVID rally. So pretty significant from that perspective. If you take a look at the NASDAQ 100, they're all kind of looking a little different. We did get 2 clusters on the NASDAQ. We are 9% below the moving average, so very extreme. Short-term sentiment, very bearish for 3 days in a row. Really, really far down here. I actually have to move this down from, it was that much more. So you can see it's also very close to dropping to its below its 23%. It got to it. It never did jump up above it yet, at least. Remember, now any rally we get is going to be a pullback for the markets, and the directional impulse moves are to the downside right now. So any upside moves are going to be pullbacks that don't start again until you break that 23% retracement, and then don't end until you come back down below it or above the 78%. If you take a look at the weekly NASDAQ market forecast, again, its intermediate line had already broken a few weeks ago, but this is the first week we've really gotten below the moving average. So market sentiment's dropping, very bearish short-term sentiment. So if this were a daily chart, we would expect that we'd start to be a little bit more bearish. It's not a daily chart, it's a weekly chart. So the expectation is not that every single week is going to be a down week. In fact, I was showing our students today, Market Scholars, if you go out to late 2018, if you compare the current week that we're having now to this week, then you can see the week after is actually relatively positive. Then we had another down week. Then we had 2 positive weeks, and then a couple down weeks, and a big So after the big drop, after a big drop similar to what we just barely had, over the next 1, 2, 3, 4, 5, 6, 7 weeks, 4 of them were actually to the upside, and with only 3 to the downside. And then we had the washout at the end. So just, if we do get bearish here, don't think that we're going to go down every day. Don't think we're going to go down every week. In fact, I expect next week to be somewhat of a bullish week, if not like this or more like like these. Either way, I expect that we will have more of a bullish week next week because of how extreme the bearishness. But I don't think that will be a bullish move. I think that will be an opportunity to be more bearish going forward after we get that rally. I don't think this bearish run is ending anytime soon. Let's take a look at the long-term chart. Obviously, red arrow, falling PPO, big differential. That's the biggest bearish differential. That's the biggest bearish candle we've had since the COVID drop, right? None of these are bigger, right? None of these are bigger there. In fact, if you were to go back, see, it's minus 4%. Let's see here. Let's go to 20 weeks. If we were to go back, you can see there's 18. We had some pretty bearish candles there. There's 15 and 16. Nothing else was this big. There's 2011. So these are all the same periods, right? 2011, 15, 16, 2018, twice in 2018, but more the last quarter. You know, these are all, and of course COVID. These are all the types of moves that we're getting right now on here on the S&P. Of course, your NASDAQ 100. Take a look at it. Your NASDAQ 100 is actually below, the Hakinyashi is below the 40-week exponential moving average. This is the third week we've had the red arrow. Obviously, you can see the differential. And then the Russell 2000, we do the 10-week, we've been below the 40-week. The 10-week is now crossed below the 40-week too. So we are in a death cross there, which you also see too showing up on the MACD and stochastics. I'll show you that here in just a second. Obviously, you have 3 red arrows across the board, light pink shading all around, so we are in bear mode here. If you look at the 2-line version of the MACD for these indicators, you know, we are breaking below the 200-day, just a little bit on the S&P. That's, you know, with a big amount of volume, I expect that, you know, we'll wash. I mean, I expect that that's a very short-term washout. We'll bounce back up off of the same, even more so on the IWM, way extreme to the downside. But you can see up here the 50-day is crossed below the 200-day, so we are just started, which means that you're going to get a retest of the 200-day on as we go up to a rally. The question will be what happens after that, right? Whether or not we go in a bear market or not. The Qs are much more below the 200 and have broken below its point of control. Obviously, a big amount of volume there too. And then finally, your diamonds have been been holding up the best until this week, and it also dropped below its 200-day moving average, below its point of control, big spike in volume. So very, very bearish day from that perspective. I mentioned you had this big unwinding of, here of, nope, not that one, this one, of the gamma exposure, and that's kind of what's been going on. As market makers unwind their gamma exposure, that actually puts pressure on the markets. You know, they unwind it after they really build into it, right? People were really building into it here, and then they've been unwinding it ever since, and that's to an extreme degree here before expiration date. That can be a trigger for a short-term bottom too. You can see a lot of these other lows line up with some of the low points here on these pullbacks. So it's another reason why I think, you know, we'll have a little bit of a short-term bottom. Let's take a look at some of these other oscillators. Look at the RSI. We are below 30 on the RSI. It's been a while since we've been below. Besides COVID, of course, it's been a while. 2018 we got below the 30 RSI. It's very rare. We don't get below it on these intermediate pullbacks. Only on the market sentiment declines. Obviously, you're below minus 150, so we're in bearish territory there for the CCI. The DMI, big extreme move above 40 on the negative indicator, way below 20 on the positive. The ADX has just crossed above 20, so we are just starting a bearish move here. Again, it kind of shows you, you know, what's going on there. We are now below minus 5. We are we are at minus 4.98, so almost below minus 5, and then we are above 80. So we are almost to very strong trending bearish levels there. On SPY, well below the cloud. Of course, we already are there on IWM, so we are at minus 5.5, or 5.5 there. We are above 80, 84, way below the cloud on IWM. The Qs, same thing, way below the cloud. Very strong trending pattern, minus 5.6. So we are in strong bear mode on all these indicators, now including the diamonds, which has been the one that's been holding up the best. It's still kind of only an intermediate trending mode, but again, they're very below the clouds. I mean, again, to show you, when you get below the clouds here, it doesn't really get like before, like on these intermediate pullbacks. You kind of test it a little bit. You touch the bottom, You maybe get a smidgen below it. You don't really get significantly below it. But when you are in these market sentiment declines, you do. You get significantly below it. You rally up, but you have a hard time getting up to it. And then, you touch it a few times and you stay below it. That's the market sentiment decline. There's the end of 2018. Go to 15 and 16. You see we get below the cloud. We stay below the cloud that whole time. We get above it briefly, and then you get back below it, and you stay below it for a while until you get back up above it. So it's really hard when you're below the cloud significantly. And we are getting pretty significantly below the cloud this time. So, I expect we'll probably get back up to the cloud, maybe a smidgen above it on any kind of short-term rally. But that's, breaking the cloud is a very significant thing. Okay, so that's the cloud. And then finally, from a Bollinger Band here, let's look at the Keltner channels. Let's look at the Keltner channels here. Oops, sorry, not that one. This one. So we are, you can see we are pushing below the Bollinger Bands on SPY. We are below the Keltner channels, way below the Keltner channels. Very strong bearish momentum. The bands are outside the channels. This is trending mode. Same thing on IWM. Same thing on QQQ, right? We are way below the Keltner channels. Now, if we rally, we might rally up to the Keltner channels because we're so far below it. The bandwidth is extremely high. The momentum is very strong with green dots, meaning the bands are outside and they're way outside. So we are in bearish mode. Needless to say, a lot of these indicators, this is kind of move we've been looking for, especially from IWM. As we've been trending sideways for so long, and then when it got that fake out like late last year, we talked about how fake outs are even more bearish than just resistance holding in the first place. And you can see what's going on here. Here's your, you can see the SPY still hasn't got a 2% move, which is crazy, but it still hasn't got a 2% move. QQQ has, but hasn't got a 3% drop. IWM has, right? So, but you can see just how bearish now. Remember, when you're in bearish mode, you're still going to get green bars. And since we've gotten four in a row here, I fully expect that we'll get a big green bar, probably above 2%, either Monday or Tuesday. Also, keep in mind, too, that the VIX still hasn't even spiked. The VIX is up. It's up to 29, but it's still not even above 100% yet. Now, when we're in market sentiment decline, when you look at how things were back in 2018 and obviously the COVID, but there's 2018. You can see we are well above 100%. We got up to 115% right at the very start, and then we of course got well above 125% at the end when we washed out there. That's 2018, 2015 and 16. This was the early part of 2018. We got above 125%, 132. Now, if I were to go all the way back to 15-16 time frame, here, let me go back over here. If I were to go back over there and zoom in, at the beginning of 2015, we got all the way up to 130%. And you can see we kind of started, but then it really took off, and then we kind of eventually washed out here at the beginning of 16. But that's the kind of spike that we are still susceptible to from a volatility standpoint that we haven't really gotten yet. So when you look at the VIX on this chart, we're up here, but we're really not that extremely far away. Again, when you look at how far away we got above these lines earlier, like in 18, here's a 2018. Look how far up above the 200-day. In fact, if I were to go MS PPO, and let's compare how far away we are. Let me get rid of the MACD and the stochastics and the volume. And let's look at how far away we are from the 200-day moving average. Simple moving average for the VIX. So you can see in 2018 right there, well, let's come over here. Let me move this. Right now we are 54.33%. So let me edit that and put that at 54.33. So that's where we're at right now. And you can see that's a pretty high level. There's COVID. right? That's how far we got COVID, way up there. There's the end of 2018. So we eventually we started with a move about this high, 65%, stayed up there about 60, but then we washed out with a move all the way up to 120%. That's the end of 2018. Look at 15 and 16. When we started this drop in 15, we got way up 170%. And then you can see we kind of touched a few times at this level. So you can see how kind of important this 50% level is. That's 15 and 16. Go out to 2011, we were way up 155% above the 200-day moving average. Its 200-day moving average. And you can see we kind of held this level for a while. We also got there in 2010, well up above this level. So like this isn't very high. Like we still haven't really gotten a spike here on volatility that would be commensurate with the kind of declines that we expect. The kind of, like, at least not necessarily like a huge depth, not a COVID drop, right? But in terms of like maybe the length of time, we might be down here for a while. The VIX might be up for a while, for multiple months up in these levels. So when you look at, obviously, the volume and trading range today were very high. The trading range was 10 points, well above the 7-point average. The volume at 202 million. Let me show you those numbers in context. 202 million is way above, way off the charts. 10 points, way off the charts for the 52-week range. The 7-point range right now is actually pretty high, but not to the 2% mark. So we're not really even, again, at market sentiment modes, to kind of show you those same time frames. You go out to 2018, we were well above 2% by the time we hit 2% in early 2018. In 15 and 16, we got above 2% there. And then, let's go out to the 2011 time frame. Over here, we were well above 2%. So I expect 2% or high, which means at 2% right now, 1% is 4 points roughly. So you're looking about an ATR of at least 8.8 or higher. So we're going to get some bigger days. We still have some bigger days left to come here. And then finally, like I showed you, the VIX, we're almost there, almost at 100%. But again, I kind of think that we'll probably stay down around 95%, maybe even dip to 90 early next week. Before, I still think the spike is coming sooner, if not by the end of next week, by the week after that. Then we'll get the big spike. Then we'll really kind of shake things out, because the market's going to be in this mode until that March meeting, until that March FOMC meeting. Now, of course, that meeting, their next meeting is actually next week. So, we'll either get some moderation on this, or the exacerbation on this, depending upon their press conference and what kind of expectations they set for which for right now is the market expecting a 25 basis point hike in March, and it's actually pricing in a 60% chance of a hike in May after that. So like the market's really pushing them into being really restrictive. Let's take a look now at how these different asset classes performed here over this past week, and you can see the declines here on the 3-month chart. But let's just go to just this week. 4 days, right? 4 days here this week, 4 trading days. You can see, it was small caps and large cap tech all going together. 8% down. The S&P down 5%. Developed markets down 3%. Emerging markets only down 2.25%. Very significant outperformance on emerging markets. In fact, when you look at the relative performance here for international equities relative to U.S. equities, big change. Look at that big jump higher, well above the 17. We actually got above the 17-week moving average last week, well up above it this week, like way up above it. So MACD is diverging to the upside. This is a weekly chart, right? Yeah. So you can see the PPO for the there's the 50 and the 200 week. We actually started the week above the 50 week, but that PPO is now starting to get above its moving average. We might be turning really positive really quickly here on this indicator. So let me kind of show you some big picture context of that. That's where it is here. So it's really low. It's really low, and it's got potential for some significant outperformance if it can turn this around and start to fill in that gap. If not, start to trend up above that gap. That you can see the RSI is higher than it's been. Big jump, like a big bullish crossover with a high ADX already. On the DMI, the CCI getting up above 100 again. So significant change. And then when you look inside of VXUS and you look at EEM relative to EFA, the International Emerging Relative Developed, you can see that's turning around too. Had been very bearish all last year, and now is turning back up to the upside with a very good MACD, and the PPO starting, the histogram for the PPO starting to rise. And there's a strong CCI, a bullish crossover on the ADX, on the DMI with a strong ADX, and like I said, the RSI. So things are turning around for international equities on a relative basis compared. In fact, when you look at the different the primary markets here, let's see right here. Oops, sorry, not that one. Here, the 12 grid. When you look at these primary markets, again, look at China. Like China, UK as well, but look at China and Brazil. India is not so bad. I mean, these are your major emerging markets here, and they're doing really well compared to develop. And the develop are doing better than what the U.S. is doing. The U.S., which has been the one outlier in terms of relative strength for so long, is obviously now the outlier in terms of relative weakness. Russia also being pretty much hammered here, down 30% in 3 months. And then Korea also. Korea being a reflection of global economic activity. All right. Let's take a look here at the asset classes on the 12 grid. And you can see the safety trades. Remember the dollar, not so much of a safety trade as much as like the euro is here lately. Long-term bonds starting to rally up those last 3 days of last week. Gold's on a new bullish trend. The 10-year yield, after peaking a few days ago, has been down the last couple of days. Commodity prices moderating a little bit. Look at the big drop in Bitcoin, down 40% now in 3 months. There's your global equities, VTs, your global equities. Developed markets and emerging markets looking much better. Silver had broken out along with copper, but not really going too strong. It's still only like a 0.5% gain over 3 months for copper. So, you know, you can see it's kind of mainly a U.S. Equity drop here. If I take a look at the how the currencies compare this week and go to the beginning of the week, then you can see here, I mean, you've got your safety trades doing the very best. The franc, the yen, the dollar in this case, along with the Singapore dollar and South African rand. But there's your all the other majors, the Canadian dollar, the Australian dollar, the pound, the euro, the Kiwi, all down here. So your safety currencies, not surprising, all were your best performing asset classes. Let's look at how the sectors performed here this week. There's your sector performance, XLY, XLK, XLC. And there's your QQQ. Financials not doing very well. Utilities and staples holding up very well. Holding up very well there, along with energy and real estate and healthcare as well. You can see industrials outperforming, materials slightly outperforming. If I take a look at their 12 grid for the sector moves, you can see clusters all over the place. Real estate, healthcare also getting clusters too. Not so much in everything else, but I mean, remember how I told you when the markets are in a significant decline, they all look the same. We don't just cycle through weakness like we have been doing all pretty much 2021. Like they'll all drop. I mean, look at that. Except for energy, which is kind of doing its own thing, and staples, and utilities, which are holding up better. Everything else looks almost exactly the same, and that's very typical of an intermediate decline. All right, so for our trade idea of the day, I wanted to take a look at Walmart. Walmart's actually been holding up really well, relatively speaking. The market's been pretty bearish. You still got short-term sentiment that's to the extreme, to the downside. The intermediate line is dropping, but it's still actually in bullish territory, which is pretty rare. That's not necessarily the case everywhere else, of course. So that's what's going on right now with Walmart. If you take a look at its long-term crossover chart, it's been pretty sideways. Obviously, you've got, a potential death cross, but mainly just because we're so sideways. The PPO is sitting right on top of each other there. We don't really have that significant of a bearish candle. When you look at the 3 green arrow chart here, you can see the stock is sitting right at its point of control on a pretty, like you've got one big volume node for the entire year with a point of control right in the middle of the chart, right in the middle of the value area. All the moving averages sitting right on top of each other. The MACD and stochastics dropping, of course, as like everything else is. If you take a look at the trend strength indicator, very noisy trend. We don't have any kind of trend going on right now one way or the other. If you look at the DMI, you see the same thing. Very noisy trend too here. Both lines are actually below 20. Positive is below 20, but so is the negative. So we're not really even trending to the downside. So when I see those kind of charts like that, you can see also the Bollinger bandwidth for Walmart. We are in the lower part of the bandwidth, but it's still a very low bandwidth. So we're not really breaking out here. So when I see charts like that, I think, okay, let's look at an iron condor on this trade. So I'm going to sell the 135, buy the 130, sell the 145, buy the 150. Of course, you're in earnings season, so that's going to impact your position sizing. We only did 2 contracts, but with those 2 contracts, you can see I've got a really good return for not very much risk. And those break evens, you can see are plotted here on the chart. So as long as we stay inside this range that we've been in for the last little bit, then that's how we make our money on this trade. So, you know, it's just a way for a stock that's kind of been more sideways, but is in earnings season, and we can probably try to take advantage of its relative strength in terms of just not going anywhere right now, and try to profit from try to get a little bit of a negative vega in our portfolio with the vega getting so high. Since a lot of our trades lately have been more bearish, directionally bearish, leans more towards the positive vega side of things. This having some negative vega here and some positive theta can help soften some of that. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Have a great rest of your weekend, and we'll see you all on Monday.